Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today we are going to be analyzing Palo Alto network stock. This one came in by request down in the comment section of one of my other videos. If you have a stock you would like me to analyze on the channel, just drop the ticker and the name down in the comment section and I'll put it on the whiteboard behind me and eventually I will make a video of it. The ones that are in the S&P 500 I post on YouTube for free, and the rest of them I post over on Patreon, which is $5 a month. And if you join on Patreon, you get a big discount to my full Cyclical Investors Club premium service over on Seeking Alpha, and those links will be down in the description of the video. As always, this is not individual investing advice. This is just how I analyze stocks. When I look at a stock, this is basically what I think of and the numbers I run, and I'm just sharing that with you. So Palo Alto, I had a comment on my recent PayPal video because I went back and I always review any coverage that I've had of a stock in the past because I create my own strategies and techniques and valuation techniques, and they aren't, well, I've taken from a lot of different great investors. You can't go and read a book from Ben Graham or Peter Lynch or anybody else, and I'm not taking one of their strategies and copying it and saying, okay, the Ben Graham value method says this is a buy. I have my own methods that I use, so really what I try to do is just show how these methods have performed in the past. Combined with my judgment along the edges, and hopefully over time I can build up a record that shows that they work pretty well. And I've been doing this for I'm in my 9th year now, so my goal when I go back and look at things and see how they've done before is just to add a little credence or to what I'm doing now. Now in the case of Palo Alto, I've only written on it one time in the past, and it's one of the worst sell calls I've had ever, I think, or at least that's how it's shaping up to be. The worst one I think that I've had before was actually Costco, which I wrote about. Let me actually, I think I have this tab pulled up. We'll look at it here. So just for fun, yeah. So I wrote about Costco in 2018. And it was a sell. It's not labeled a sell article because they didn't have the ratings there, but it was, and it's up almost 300% in the past 5.5 years or 6 years or whatever since then. The mistake I made with Costco was I miscategorized it. I didn't have all the strategies developed that I have now, and I was treating Costco as a cyclical stock because its price had been very cyclical in the past, and I was just pointing out that it could do that again in the future to people, but it hasn't done that. It hasn't done that since then. And really, what I learned at some point, within a year or so after I wrote this article, was that you want to look at the earnings first to determine the business's cyclicality, and then you also want to look at the price. But you really want to look at the earnings first. And based on the earnings, Costco actually wasn't cyclical. And I think that, not deeply cyclical anyway. And that was what I got wrong about Costco. Now with Palo Alto, let's see if I have that one here. No. Is this it? Yeah. So with Palo Alto, I wrote about it about a year ago, pretty much right at the bottom of its decline back then. So you can see right here, I nailed the bottom with my sell article. It's up 128% since then in a little less than a year. So I made a similar error, I think, with Palo Alto in that I probably miscategorized it. The dangers that I talk about were present and still are present probably, but they didn't materialize at the time since then, basically. So I was treating this as kind of a slowing growth stock that could see multiple compression in the PE when it really wasn't slowing yet. It didn't slow. It actually accelerated. It like did the opposite. So I should have treated it as a fast growth stock. So I didn't own this one, but if I had owned it and I had bought it as a fast growth stock that still had years to grow pretty quickly, then that's my buy and hold strategy actually. So I wouldn't have sold it even if it looked kind of overvalued based on earnings and whatever. But when I treated it here in this article, I treated it as not as the really fast growth times were over, and it was still going to probably grow. I think I assumed it would grow at 20%, which is fast, but it's not 40%, 50%, and so forth. And so that's where I went wrong, because they ended up having like a great year. So I had this pulled up a minute ago, but I want to pull it up again. So here was the setup that we had back then. We had this, the current PE was 46, so it wasn't cheap. The earnings since the mid 2019 had actually been growing about 23%. And they were expected to grow or to slow to 18%, so less than 20%. And I think when I did this valuation, here's the since 2018, 23% growth. So these days of 100%, 90%, 60%, 40%, 37%, and you can kind of see the trend actually of it slowing. And then we had COVID, which you could maybe put asterisks next to, but then you still just had kind of mid 20% growth, right? For a 40 PE, that's still pretty expensive. And then I also thought that this year, pretty high risk of a recession, so there was possibility that this 35% growth would even miss. And all those things combined created a lot of danger, I thought, for multiple compression. Even if you thought these earnings growth rates would eventually kind of come back at 18% growth isn't really enough in my mind to support a 46 PE. So that was my thinking here. But what happened was, let's see, they didn't slow. Spoiler alert. So right here was when I was writing. Actually, even worse. I might have even timed the bottom perfectly. Yeah. So you saw in the fast graph before, and we were already halfway through this year, right? And they were expecting 35% growth. Well, Palo Alto just blew those numbers, like expectations, completely out of the water. They just totally crushed it. And so we saw this gigantic growth that really wasn't expected by anybody. But that happens sometimes. Now this is why I don't short stocks. So when I have a sell rating, that's more like if I owned it, I would consider selling it because of the valuation or whatever the reason was. But not that I would go out and like short a stock like this. I don't short any stocks, despite what people claim when I write my sell articles. Everybody always thinks I'm a short seller for some reason. I'm like, no, I don't do that. All right, so and then we have even more growth, and then we're way up here, and then they expect 18% growth going forward. So really just Palo Alto came and they just blew all these expectations out of the water. The growth accelerator was basically turned on. The idea that they would slow their growth is out the window, and they're off to the races. So with that in mind, I think you have to kind of think of what position your investors in now, right? I don't own this one, but if I owned it as a long-term growth stock and a person bought it somewhere down in here and it's had this great run, for me, if you buy it and you think the long-term growth is good, if you think they can do 20% a year for the next 3 years pretty solidly, then this is just a buy and hold stock and just put it aside. Now, that doesn't mean it won't go down or can't go down. At some point, it's going to fall 50%. But the thing is, if it goes 3 years before it falls 50%, you're up still, right? And then assuming it finds a bottom and it kind of levels out at a lower growth level or whatever. So if you think that it can do this, it's probably a hold here, okay? Now, if you think it's more in the category of what I thought about at the beginning of last year, then what I would do is here's how the numbers look based on earnings. So I've done these earning analysis before. I'm not going to get super into the details, but I assume a 20% growth rate. That's kind of what analysts are looking at now. So it's pretty much right on target of what they think. I'm looking at a PE that's about 56 using forward earnings. So debt is not an issue, so they don't have any. So 56 PE and 20% earnings growth. When I run that out 10 years, I get a CAGR, like an earnings CAGR, if you own the business and you just collected all the earnings for yourself, of 4.51%. So that's below 5%. That's usually the level where I would consider selling something. So I would say the valuation is lofty and it's somewhat dangerous here. But when something's growing at like 70%, these can fluctuate a lot. If they blow out earnings again, then this is gonna look fine. And really, it's only a little more expensive than the wider S&P 500. So it kind of depends on the type of investor a person is. I think the stock could fall like 50%. I have 60 here. Actually, 133 is where it's been down to in just the past year or two. So this isn't like a crazy number. This 143 number is probably maybe a better number to use because this is my recession estimate. So if we don't have a recession, I think the stock could, on its own, without any external factors, if earnings growth just slows and they have a couple earnings misses in a row, the stock could easily fall 50%. Unfortunately, these type of moves will probably happen like overnight. So, I mean, a trailing stop or something like that might be a good idea, but if it falls 25% overnight, then your trailing stop might not do any good. So, I mean, maybe, a stock similar that I had a similar thing happen that I actually owned recently was Netflix. I bought it right at the low in, I actually bought it twice. I bought it on the way down and then I bought it right at the bottom using two different strategies. I also bought AMD near the bottom, and I did this with AMD too. And once Netflix got to these lofty levels, because I was using a similar valuation for it, I sold one of my positions. So, and I just kept the other one and held it long term. And I think probably that's the way to go with Palo Alto here. If you don't like the idea of losing 50% and it makes you nervous, and you've done well and you're like, I've done well, but the valuation looks, usually I'm assuming that's maybe why someone might ask me about this. That might be a situation where, look, you really can just sell half of it, let yourself sleep well at night, and then just commit the other half for holding it forever, basically, for 10 years, right? Just don't even check in on it. That's pretty much what I've done with AMD and Netflix, who I kind of put in a similar, they're different companies, obviously, and there are differences, but they're similar type of situations where there's this secular growth that they could just go crazy long term, but the valuations are lofty, right? So I don't usually do that. Those are the only two stocks maybe I've ever done it in the past 5 or 6 years. But these kind of situations can set up pretty well for something like that. So that's my thoughts on Palo Alto. It's hard when you have a fast grower because you can't model out like earnings very well. This is 20% growth. It's very over 10 years. It's hard for any company to do that. But that doesn't mean they can't come in like a year like this year where earnings were up 75%. So that just changes the whole outlook when that happens. So that's what makes these tricky. But a person who's up big, taking some off here, and then at the same time committing with the other half is a pretty good strategy. Because then what you don't want to do is panic or just constantly be having to like make decisions about, oh, is now the time? Is now the time? I've done well, but it's down. If it falls 20%, is that when you're gonna? It makes it better to take that money off and then just commit to the rest and just, you don't even look at it for a decade and then come back. at least I find that, when I get into that situation, which I don't happen very often, and I'm not very emotional when it comes to investing. But I know most people are more kind of emotional than I am. But I am forced to look at my stocks every day because it's what I do for a living. And in that kind of situation, that's an option. All right, thanks for watching. Maybe hopefully you found this a little bit useful. You get to see that I'm human. I do make bad calls every now and then. And if you enjoyed this, hit the subscribe button. I'll see everybody later.